think we got everybody. Record. All right. Good afternoon, everyone, and thank you all for joining us for today's A Month of Service presentation of foreclosures, mortgages, home equity loans, and reverse mortgages. My name is Nia Murray. I am the programs coordinator with Neighborhood Recovery Community Development Corporation, and we are one of the partners in the A Month of Service collaboration. Also included, we have the City of Houston's Department of Neighborhoods, and also joining today, representing our presenting partner with Lone Star Legal Aid, we have Ms. Lauren Masulo Martin, who will be presenting the information for you today on foreclosures. Also included in our partnership, we have the Earl Carl Institute, Houston Volunteer Lawyers, Texas Legal Services Center, the Harris County Tax Assessor Collector's Office, and the Harris Central Appraisal District. And together we make up A Month of Service. And basically, A Month of Service is the collaboration of all of our organizations coming together on a monthly basis, offering a variety of different workshops, resources, and information to the community about the importance of asset protection, asset building, the maintaining of generational wealth, and community empowerment. Um, Over the last several years, our collaboration decided to get together in an effort to reach more people, to create a larger impact, and service a lot more of the community that we all service and represent. This virtual platform has allowed us the opportunity to reach people from around surrounding counties and throughout the entire state of Texas. So do know that regardless of where you are joining us from, that the information that is presented today is relative to the laws and in the entire state of Texas, not just for the city of Houston or for Harris County. Also, keep in mind that the information that does get presented here today is for educational purposes only. It is not to be considered legal advice. However, we do encourage you to reach out to our legal service partner organizations like Lone Star Legal Aid if you find yourselves in need of any civil legal assistance, especially that related to foreclosure, if that's an issue that you all are facing today. Um, this is your opportunity to ask questions of the expert that we have here. Ms. Lauren is an attorney at the Lone Star Legal Aid Office, and she'll give an introduction of herself. But again, this is your opportunity to ask questions. However, we do ask you to try to keep your questions to be as general as you possibly can. We are on a virtual platform. We do record the session as well as broadcast live on our social media channels. And we don't want your personal information kind of getting out there for everybody to have access to. So do keep that in mind as you're asking your questions. We want to try to protect your privacy as much as we possibly can. So don't divulge any detailed information. Do leave that for a one-on-one, and we do encourage you to apply for the services of Lone Star Legal Aid. In addition to that, we want to welcome you and thank you all for joining us today. We hope that the information that does get presented here today, you will find beneficial. We do ask that you pay it forward and share it with other people that also may be in need of any information about foreclosures as it relates to mortgages and home equity loans and reverse mortgages. We know that there's a lot of information, a lot of misinformation that's out there, a lot of, you know, social media posts that are out there for folks kind of, giving little blanket statements and information that does not relate to the laws in the state of Texas. So do make sure that you do your due diligence and research and vet the information that you are receiving to make sure that is relative to the state of Texas laws and not, some other place. So do keep that in mind as well. But with that being said, we want to thank you all for joining us and hope again that you do get the information that is needed. We want to welcome you for all of those that have never been on our station before. And for those that have joined us previously, we want to welcome you back and thank you for your continued support of this collaboration and this partnership. If you are joining us again on this Zoom setting, feel free to type your questions into the comment section and we can read them aloud at the end, or you can unmute yourself and raise your hand, and we'll allow you the opportunity to ask the questions directly of the presenter. If you are joining us on our social media channels, please type your question into the comment section. I'll be monitoring that, and I can ask those questions for you at the end of the presentation as well. So with that being said, we have a lot to cover for you today. We want to welcome you back anytime to join us in case you missed the information, or you think about another question that you want to ask in the future. We do divide the foreclosure presentations into 3 segments, and we repeat them on a quarterly basis. Again, this foreclosure presentation is specifically about reverse mortgages, regular mortgages, the home equity loans, and things like that. Next month, I believe we will be back on no, not property tax. We'll be on HOA
I believe
foreclosures
so.
in August. We generally take the month of July off, so we will resume in August with the HOA foreclosures, followed by the property tax foreclosures, followed by another presentation of the mortgage foreclosures. So watch for the rotation of that. I will include a copy of the schedule of upcoming workshops that we do have, and hopefully I can get the schedule already confirmed for the month of August, so that I can include that when I send out the link of the recording for you as well. If there are any workshops that we don't currently offer, and there's something that's important that pertains to your particular situation, or what or that you see that's kind of happening in your community or what have you, if you could just reach out to us and let us know, or at the end of the presentation, there's a link that pops up for a survey. Just take a couple of minutes to fill that survey out to say, hey, do you mind doing a presentation about XYZ, and let us know. So as we're planning for the fall, then we can take that into consideration into our schedule for the fall. So you have the opportunity to express yourselves that way as well. So, all right, we're going to go ahead and I'm going to turn it over to Ms. Lauren to have her introduce herself, and we're going to get right on into the meat of why we're here today. All right, so Ms.
Okay.
Lauren Masulo-Martin with Lone Star Legal Aid.
Great. Thank you so much, Nia. So happy to be here, and I've really valued our partnership for the last many years. So we're very glad to be here on different topics. And again, my name is Lauren. I'm with Lone Star Legal Aid's Foreclosure Prevention Project. I'm a staff attorney there. I've been with the firm about 8 years, and with the foreclosure prevention about 6 years. So, and I'm going to share my screen to for a PowerPoint.
Loading.
Okay, let's see. And is that all
You're good.
showing?
More for mortgage foreclosures. We got it.
Okay, fantastic. Okay, and as Ms. Nia said in the beginning, of course, today's information is legal information only, not specific legal advice to your circumstance. So we can't tell you what kind of loan or loss mitigation options you should get. If there's any tax consequences for you, you should talk to your own advisor or lawyer for your situation. And today, just a brief on our agenda. We're going to talk about Lone Star Legal Aid so that you know who we are and what resources we have, because we do a whole bunch of things other than only mortgage and other foreclosure issues. So, and then we're going to move into the substantive or the meat of our presentation today. So first we'll give kind of a high level overview of mortgage foreclosures. What does that process look like? And then we'll talk about something called loss mitigation, which is the way that you try to get back in good standing on a mortgage so that you can avoid foreclosure. And we're going to highlight a specific foreclosure related issue that comes up when those individuals who are heirs on a property. Next, we're going to talk about precise or specific different types of mortgages. That's when we'll get into the reverse mortgages and so forth. And then if we have time at the end, we can always take questions. Okay, so just about Lone Star Legal Aid. We're here to protect and advance the civil legal rights of millions of Texans living in poverty. We serve over 76 counties by providing free legal advice, legal representation, and community education like this to ensure equal access to justice. Some fast facts. So again, we have 76 counties, and that actually includes 4 in Arkansas. So we're on the eastern side of Texas from, as far south as Galveston and so forth, all the way up to Paris and Nacogdoches and those areas. We have 14 offices. There are over 1.9 million people in our service area that qualify for our services, meaning that they're at 125% of the poverty level. So over almost 2 million people. And as of 2024, or in 2024, we served over 61,000 individuals with their legal needs. Of those, 32%, so about a third, were domestic violence survivors, 18 and a half, so about 20% were seniors over 60, and 7% were veterans. Who do we help? We help everyone, children, veterans, seniors, LGBTQIA plus community, people with disabilities, homeless, single parents, people whose languages are not primarily English. We do rural services, urban services. Our main office here in Houston is where I'm located, but again, we have service areas throughout the state. One interesting fast fact is that in Texas generally, there's about one attorney for every 380 people in the general population. However, there's only one legal aid attorney for about every 17,000 people in our service area below 125% of the federal poverty level. So you can see why our demand is so high. Again, our mission is to protect and advance civil legal rights for the millions of Texans living in poverty by providing free advocacy, legal representation, and education. We do work on civil cases, meaning anything that's not criminal. Think family, car, money, things that are not health care and so forth, things that are not criminal. And we also can't help with immigration. Some specific examples of those law types, consumer law, again, money, housing, car, employment, family, divorce or protective orders, housing, foreclosure, eviction, and so forth, public benefits like food stamps or SNAP, Medicaid, so these different things that we can help with. We also have special projects, just like one of the special projects is foreclosure prevention. We specifically focus on helping homeowners overcome property tax issues, HOA disputes, and title problems and mortgage problems. But there are other programs, for example, disaster relief. Maybe you're having trouble with FEMA or our eviction right to counsel unit for tenants. So we have a number of specialty units. And how do you ask for help? You can apply 24 hours a day online at lonestarlegal.org. That's lonestarlegal.org. And you can also call 1-800-733-8394. Again, 1-800-733-8394, Monday through Friday, 8 to 5. Here are some branch offices: Houston, Galveston, Conroe, all the way up to Texarkana. We are on social media, Instagram, Facebook, and YouTube. That handle is at Lone Star Legal Aid for all 3 of those platforms. Okay, and now we're going to get into the main presentation. So mortgages, we're starting today with an overview, basic definitions, Mortgage 101. So what are some types of mortgages? The first one is a forward or purchase money mortgage. That's probably the first thing that comes to mind when you think of mortgages. You get money to help you buy a house. Then there are reverse mortgages, which are special mortgage products that are available to the elderly. They are very regulated, but they can be a good option. But you have to take different things into consideration that we'll talk about. There are things like mortgages that can come out of loss mitigation. So a deferred balance or a partial claim, meaning something when you've gotten behind, they may put a mini loan at the end of your regular loan to get you caught up. And then those things come up as a lien at the end of the mortgage term. And then there are home equity lines and lines of credit. There are executory contracts, which are when you kind of buy from a person usually. And there are even what they're calling zombie mortgages, or mortgages that people took out many, many years ago thought they were discharged in bankruptcy or that they'd paid them off and now they appear again. So mortgages can actually encompass a lot of things. And forgive me for one moment. My throat is getting a bit dry. Thank you. So mortgages place a lien on a borrower's home. A lien is an obligation to pay a debt that can be enforced by selling or foreclosing on the home if the borrower doesn't pay according to the terms of the contract that created the lien. Pardon me. The lien can be foreclosed by selling the property if the contract terms aren't met. And the home may sell for less than the market value, which could result in a loss of equity. We also often see that. So one reason to try to avoid foreclosure is to make sure you're maintaining the equity in your home. There are two main players that we'll talk about in the mortgage context. Those are the investor or insurer of the loan, the owner of the loan, and that's the entity that finances or backs the loan, who is the money owed to at the end of the day. And that entity dictates or determines what loss mitigation options are available to the borrower. Meaning, what can the borrower do to get back in good standing? That's up to that investor or insurer. That investor or insurer could be a federally backed entity. So examples of those are Fannie Mae, Freddie Mac, or Ginnie Mae government-sponsored enterprises. It can be the Federal Housing Administration, which is a department of HUD, can be the VA, Veterans Administration, or Rural Housing Service, part of the USDA. So there's actually government involvement that could be sponsoring the loan, or it could be a private entity that is like a trust or a bank. So you have the investor, and then the investor has an agent called a loan servicer. And that agent takes care of the everyday operations for the investor. So they're the one that interacts with the borrower. Oftentimes, when you say my mortgage company is, you're referring to the servicer. They're the ones you make your payments to. They're the ones who will call you if you're behind on your payments. They're the ones who send you your monthly statements. And the mortgage servicer is the entity that you have to stay in touch with and work with when you're trying to get out of default. But the servicer is only offering you the options that the investor is allowing. So keeping that in mind. Some notes about investors and servicers. So your loan can be sold from one investor to another. You don't have a choice. And your servicer can change too. The investor picks the servicer. You'll get a letter in the mail about these changes, but just be watching because you could get a letter saying effective X date, don't send your money to this servicer, send it to the other. And then you need to make sure you set up with their online portal or make sure your your checks get sent to the right place. So just keep those things in mind. And on occasion, the investor and servicer are the same company, but many times they are two different companies. Now we'll go over mortgage foreclosures in Texas generally. So mortgage of some sort is on the home. What happens if you're facing foreclosure? So how could a person face foreclosure? They have to be in what's called default. And a default is when someone doesn't keep up with the terms of the mortgage. Most common defaults, of course, are missed mortgage payments, but it could also be a failure to pay your property taxes or to keep homeowners insurance. The mortgage company will require you to do that because property taxes can foreclose too. Properties can get damaged if they don't have insurance, they can't get fixed. So the mortgage company wants to make sure their collateral, your house, is kept in good order. So you have to pay the taxes and insurance. Again, you may get back in good standing with loss mitigation. So what are some reasons why people might get behind on their mortgage or in default? So sometimes they have a high cost loan or a loan that has a variable interest rate that they could afford in the beginning, but then it became out of reach. Obviously, there could be a loss of income from um, loss of a job, a disaster that impacts how many hours of work they can do for a while, a divorce or a death of someone who brought income into the household. You can also see increased expenses like medical expenses. And then with reverse mortgages versus other mortgages, you pay your taxes and insurance usually to the mortgage company and they disperse them. But with reverse mortgages, you pay them on your own and the mortgage company checks behind you to make sure they're done. And if you don't do that, you can be in default as well. General mortgage foreclosure information. So Texas for mortgage foreclosure is generally a non-judicial state, meaning non-judge, no lawsuit. So many times mortgages can be foreclosed without a lawsuit. All foreclosures in Texas, whether it's HOA, property taxes, mortgages, happen the first Tuesday of every month. And there is a law that if that Tuesday is January 1st or 4th of July, it does fall to the Wednesday, but otherwise it's the first Tuesday of every month. Now, under federal law, which preempts, Texas law, the loan servicer cannot send the first foreclosure notice, meaning you've been scheduled for foreclosure sale notice, or file a foreclosure lawsuit when that's applicable until the loan is at least 120 days delinquent. So you don't want to get to that point, but there is a little cushion of time, but that is a requirement. And then the loan servicer prior to that must send a notice of default letter giving the borrower at least 20 days to fix the problem. So they have to send you a letter saying, here's a problem, you have 20 days or more to fix it. If you haven't fixed it by that deadline, the loan servicer does what's called accelerating the loan, meaning the whole amount's due. And they send you a letter basically telling you that the whole amount's due, and it can be combined with the notice saying that the home is set for foreclosure sale. And the exact process will depend on the type of loan and type of default. But if your home is foreclosed upon, it doesn't mean you're on the doorstep next day. They do still have to evict you formally, the new buyer, just so that you're aware. A few more specifics about non-judicial foreclosure. Again, it's when the terms of the mortgage contract, the deed of trust, you have agreed that they are allowed to foreclose without a lawsuit. Again, they need that 20-day notice of default and then a 21-day notice before the sale. They just have to send it. They don't even have to prove you received it. Um, with a reverse mortgage, it's got two different ways to foreclose. The non-judicial foreclosure generally occurs when the last borrower passes away. The mortgage lender is supposed to try to find heirs, but they don't always do so successfully. We see that most when there's like a surviving spouse who for some reason wasn't on the original mortgage. So that can be a time when they may foreclose non-judicially. There are a few carve-outs, even in Texas, for judicial foreclosure when the terms of the mortgage or Texas law requires a lawsuit to be filed. Sometimes they file a lawsuit even when they don't have to. If there are heirs, if a borrower has died, sometimes they don't. Sometimes a lawsuit, when they do file a lawsuit, they make it what's called expedited. Typical lawsuit could take a year, but there is this special carve out for an expedited foreclosure lawsuit. And services they don't even necessarily have to have a constable come give you the lawsuit. It's just they mail it to you and you get 38 days to respond. So keep watch of your mail if you're behind on your mortgage for notices and for lawsuits. With a reverse mortgage, a judicial lawsuit is required when a borrower doesn't pay taxes, HOA, or insurance. So again, it's that two different types with reverse mortgages. But even after the lawsuit, if the judge orders that the foreclosure can go through, they still have to send that 21-day notice before the foreclosure sale. And again, they don't have to prove that you received the letter. Okay, so at this juncture, we want to mention foreclosure scams because we've started to see some of these. It's interesting to note that it becomes public record when a foreclosure lawsuit is filed, or when a notice of foreclosure sale is recorded, because they have to take that 21-day notice and actually record it in the county clerk's record. So that is public record. And so investors, scammers, different people can find out that you're facing foreclosure. They may send you letters. They may find your phone number and call you. They may knock on your door. I was doing a home visit when somebody knocked on the door of my client. They don't be pressured. The Federal Trade Commission has a great article as well, consumerftc.gov, consumer.ftc.gov. You can read more details. You can also contact what's called a HUD housing counselor. You can go to HUD.gov to find one. Just a few quick examples. Phony counselors. So it will never be a charge to actually do your loss mitigation or negotiate anything with your mortgage servicer. If somebody says, just pay your mortgage to me and I'll negotiate for you, or give me this payment up front and I'll help you apply, that is something you're entitled to do free of charge. There'll be rent to buy, where they'll say, well, give me the deed and we'll let you rent from us. Again, you're giving up title to your home. And then equity skimming, when somebody's wanting to sell, they will offer a very low price, trying to convince the person that their home isn't worth more. I even just saw one recently where by email, where a scammer appears to have copied the logo of a prominent servicer and put it into the email to make it look like it came from them, and said that, I'm agent number so and so, and this is my name, and you owe this precise amount to the penny for your escrow account. So it starts sounding, legitimate. So just be really cautious when you see things like that. So now we'll be moving into loss mitigation. So you've learned about home foreclosure prevention and how foreclosures occur, and now we'll talk about ways to prevent them. So loss mitigation is the process of working with your loan servicer to avoid foreclosure. There's two different types. First is what's called home retention loss mitigation, which is the group of types of loss mitigation that allow you to keep your home. And then there are some times when you don't qualify for home retention. And then that's when you're looking for a graceful exit, some kind of loss mitigation that will avoid foreclosure, maybe let you get a little bit of money to help you move, those kinds of things. So the loss mitigation options will vary based on the type of loan, the investor, and various borrower eligibility factors like income. So here are some examples of home retention loss mitigation that you might encounter. So, and you might be able to do one or more of these if you qualify and if the investor offers them. So one might be a reinstatement. If you're fortunate that you just suddenly have all the money to pay what is owed and you can make it in one lump sum, they may let you just pay it off and keep moving. Forbearance is where they actually give you permission to temporarily not make your mortgage payments. You've had a hardship. You tell them, I've lost my job. I need a little reprieve. You're still in default. You still owe the money, but at least they're not going to proceed forward with trying to foreclose because they've given you permission to not pay for a certain period of time. A repayment plan is where they will take what has built up over time, what you owe, and divide it over a certain number of months, and you would pay your regular mortgage payment plus that additional monthly payment for maybe 2 years or 1 year to get caught up on what was owed. A loan modification is where they're actually making changes to the original loan terms. They're reevaluating you based on your eligibility and income. They're, possibly changing the interest rate, changing the term, making you owe money again for 30 years or 40 years, what have you, but changing the terms so that you can afford your mortgage. Then there are these things called deferred balances or partial claims. So maybe you can't afford to reinstate, you can't afford to pay what you are behind on all at once, and you can't afford to do a repayment plan by paying it off a little bit over a year or two. So they just put it at the end of the loan. But keep in mind then that all becomes due when your rest of your loan is paid, and you may have to refinance it or pay a big lump sum at the end. And then reverse mortgages even have other loss mitigation options. Now here, when we're talking about loss mitigation, I want to focus or draw attention to what happens to heir property owners. So heir property owners are people who inherited a home after the original borrower or the original owner, the record owner dies, or they divorce them. And this is a specific type of person who sometimes kind of finds themselves in default because of this change in circumstances. Um, and they have this additional barrier that they can't even communicate with the loan servicer because they're not the borrower on the loan. So say mom had a mortgage, adult daughter is living there. Mom has left the home to adult daughter, but it has a mortgage on it. That mortgage doesn't go away because mom passed away. The adult daughter is now responsible for it. And the mortgage company doesn't have a contract with this adult daughter, so they don't know who they are or whether they can talk to them. And so now perhaps they're not taking mortgage payments if they know the person has died. The insurance is in the mother's name, not the daughter's name. It creates a mess. So you do have to prove to the loan servicer that you are what's called a successor in interest, the person who succeeds or follows the person who had the original interest in the loan. And they have to what's called confirm you. So you have to prove that you are the successor. Um, you have to show that you have a title interest or a legal right to the property. And it has to be reasonable in light of the laws of the jurisdiction. So, for example, you're the adult daughter, you call in and say, Mom has passed away. I inherited the house. Now they've identified you as a possible successor. And they're going to want you to send in things like your photo ID to show that you're living there and who you are. And they may ask for what's called probate documents. They may say, bring me, send in a court document. Well, they also have to consider what's reasonable for Texas. And Texas has some options for non-judicial probate too, meaning paperwork like an affidavit of heirship, something to show that you had an inheritance. Um, and they have to be willing to take those. And sometimes we see that as an issue, and that's when people come to us asking for help. So typical problems that these successors encounter, again, the loan servicer won't talk to them. And sometimes then the loan servicer doesn't stop sending monthly statements, doesn't send notice letters, or they get sent to the wrong place. They're not on the homeowner's insurance. I've had times where they've even cut off the website. They won't allow loss mitigation. So maybe the previous mortgage was a little too high, but the heir can pay something and they want to set up that arrangement and they can't do so. We see cases where there's a divorce and there was domestic violence, perhaps, and the servicer is still requiring the ex-spouse to sign off on paperwork. And then again, some other issues, they ask for unreasonable documentation and they send, sometimes it's clear and sometimes it's pages and pages of confusing instructions. Um, so when we're talking about successors, they're sometimes they're actually inheriting the property through a will or through a formal court probate proceeding, but often they're what's called heir property owners, meaning they are the person who's living in the home, they're an heir of the borrower, maybe they're their child, their surviving spouse, but they didn't, the borrower or the owner didn't have a will. And so they just kind of got the keys. Everyone knew mom wanted them to have the house and they stayed there, but there's no proof that they're actually the one who inherited it. As far as the world's concerned, it looks like the last deed is in that original owner's name. So under Texas law, technically title does pass. The persons who are the heirs inherit, but nobody knows. And sometimes people have a will, but they leave all their property in equal shares to someone, and now a bunch of heirs all own it together rather than just the person who's living there. Sometimes they call that tangled title. So when somebody could have multiple heirs, like for it may be all their children in their case, and now numerous people own the property altogether. Um, so tangled title is that is kind of what they call that when a bunch of people all start owning the title together. And that can lead to foreclosure because people have trouble proving that they are an heir. They can't get caught up on the mortgage, and now they are at risk of foreclosure just because of that for confusion. And just as an aside, tax foreclosure happens too. They lose their exemptions, they owe a ton of taxes because the tax office or the appraisal district doesn't know that the heir has now taken over. You can now get your homestead exemption and tax deferral as an heir. So there are other presentations through AMOS that talk about that. So just keep that in mind if you're having tax issues and you've inherited your home. So moving back more to the substance of mortgages. Um, so engaging in loss mitigation or trying to do something to get your loan back in good standing is a type of loan servicing issue. So again, the mortgage servicer, that entity that you talk with, they do all sorts of things to keep track of your mortgage. They mail your monthly statements, they take your money, and they do what's called loss mitigation again, and that is a type of servicing task. So you can encounter issues when you're trying to do that. One option, of course, is to talk to the servicer and escalate, with their management and so forth. But if you're having troubles, they're saying we don't recognize you as the successor in interest, or you owe money and we're not offering you any option to try and get back in good standing. Then you might escalate with your investor on the loan. So if it's Fannie Mae or Freddie Mac or FHA or HUD, we have some phone numbers on the screen there. You can actually ask your mortgage servicer, who is my investor that backs my loan? If it's the FHA or the VA or the USDA, it'll be very clear on your deed of trust or your loan documents that you have. Um, Fannie Mae and Freddie Mac also have a loan lookup tool online to see if you have them as your investor. But try to contact that entity. You can also contact the Attorney General, the Texas Office of Consumer Credit Commission, or the Consumer Finance Protection Bureau. Now, if another option that you might try is writing a letter to your loan servicers. So there is actually a federal law that requires loan servicers to respond to specific types of letters called a request for information or a notice of error. Sometimes they're called qualified written requests. So you might see these acronyms, these ROI, NOE, or QWR. And they're a special type of letter governed by the Real Estate Settlement Procedures Act. And you have to send them to a specific address. So if you look at your mortgage statement in the fine print or you look at the loan servicer's website, you may see where it says to send ROIs and NOEs sent to this address. There'll be a specific address and you can send them a letter and you can ask them for information like how much do I owe? What are my loss mitigation options? What do you need from me to prove I'm a successor in interest? All of these different things. And you can also send them notices of error, send them letters saying, you've done this wrong. You're not offering me any options to get my loan back in good standing. Tell me why. And they are required to actually investigate that and answer your request for information and your notice of error. When you're writing this letter, make sure you put everything on it that identifies the loan. So the name of the borrower, the property address, the account number with the servicer, maybe the last four of the social, just enough information that they can figure out whose loan this is. Now, the one challenge with these is on the one hand, you have the law behind you, they're required to respond. On the other hand, it does take a while for them to respond. They're given 30 days, not counting weekends and holidays. So in practice, that's probably more like 45 days. And they can also say that they need 15 more days. So you're looking at up to 2 months to get a response. So if you're at an immediate foreclosure risk, definitely send these. Sometimes they respond more quickly, but at the same time be escalating, trying to talk to supervisors, so and so forth. But we do have, if you're wondering, what do I write? We have a tool. Lone Star Legal Aid offers a tool. You can go to our website at lonestarlegal.org and click on the resource library. There's a icon and sort it by foreclosure, and a tool called Get Help If You Can't Pay Your Mortgage will pop up. It says A2J, which is Access to Justice Self-Help Tool. And that has a lot of resources in there, one of which is how to write one of these letters. So briefly, we're going to talk about home equity loans and HELOCs. So now we're getting into the portion of more details about specific mortgages now that you've learned kind of the generalities. So home equity, what is that? Home equity is the amount of money that your property is worth minus any existing mortgage or other liens like property tax liens. So liens are things that can be foreclosed on in sold, make your house be sold if you don't pay them. So an example is if your home is valued at $100,000 and you have a mortgage of $75,000 and no other liens, no unpaid taxes, and so forth, then you have a home equity of $25,000 left. So home equity loans are getting an entity to lend you money to help you tap into that additional amount. A home equity loan traditionally has a fixed interest rate. You traditionally get a lump sum up front, and then you pay it back month by month like a regular mortgage. You often get a home equity loan if you need, say, repairs on the home or have a reason to need a lump sum of money up front. It's occasional, but you could get a second mortgage if you already have a small first mortgage and they're willing to lend to you, but that's an option too. But you're trying to get into this equity that you have. But just like any other mortgage, if you default on a home equity loan, the lender can foreclose. And then something that's similar but slightly different is a line of credit, a home equity line of credit. In that case, you have what's called a draw period, a certain amount of time or borrowing period where you can borrow money and make payments. And then after the draw period, you can't borrow anymore. You enter a repayment period where you have to pay back every month. Confusing thing about this is sometimes you wind up with a balloon payment, a big payment at the end of the loan term because based on how much you borrowed at the beginning, you're not paying enough every month to pay it off. So it can get very confusing. It also can often have an adjustable rate, which makes you pay more than you expected. And again, it can be foreclosed if you don't pay your mortgage, just like any other mortgage. Reverse mortgages. So these are actually regulated by various laws, and they are special loans designed for persons age 62 or older. And you have to own your home and live in it as your primary residence. So if you're 62 and older, own it and live in it as your primary residence. You no longer have, you won't have personal liability to repay the loan. The security on the loan is the house only. So you are not making monthly payments towards a reverse mortgage. However, you do have to pay your taxes, your HOA fees, and your homeowner's insurance. And typically, with a regular forward mortgage, you're paying a certain amount to the mortgage company every month. And then one of the things the servicer does is disperses money to the taxing entities, to the insurance to make sure those are paid. But with a reverse mortgage, you have to do that yourself. Um, Borrower, you must have some equity in your home to qualify. So there's actually fancy math that's done to make sure that the home is worth enough that they are willing to lend to you, knowing the home is the only thing that will be able to pay off the loan later. The home also has to have proper maintenance, or you have to have enough to be able to borrow and set aside money for the maintenance. So a regular mortgage, as this graphic shows, over time you owe less because you're paying every month. But a reverse mortgage, over time you owe more. So you may get money out in the beginning. They're structured different ways. You can get money one time in the beginning. You can get money a little bit every month, this kind of mortgage. But over time, you're not paying anything back and the mortgage is balance increases. The balance can actually grow higher than the value of the house. That's why I said on the front end, they're doing math to see if they anticipate that the house value will cover everything. But these are insured by HUD, Housing and Urban Development. So once the balance gets too high, they may actually reassign the mortgage, or the investor will give the mortgage over to HUD. And so it is an interesting situation. The loan balance becomes due under very specific circumstances. So if the borrower sells the home, just like any other mortgage, you have to pay off the mortgage. If the borrower no longer occupies the home without permission for more than 12 months. So if you're going to leave the home, um, maybe you're staying in a medical facility, but it's only short term, a month or two, then you can keep this reverse mortgage. But if you're going to be out kind of permanently or more than a year, you either have to get permission or from the servicer, or you will no longer be able to keep that reverse mortgage. They're going to make it all be due, whatever money you borrowed on that mortgage. The case that we see sometimes is when the last surviving borrower dies. So if there were two spouses, if there was a couple, two spouses, and they both were on the loan documents, they were both borrowers, then one passes away, the loan still stays in place. But when the last borrower, the last spouse passes, then it comes due. We often see problems when, for whatever reason, one of the spouses wasn't on the original mortgage, and now the spouse passes away who is on the mortgage, and the surviving one is left, and they make the mortgage come due. And so we'll talk about that, but that's when the mortgage is due, when the last borrower dies. And then when the borrower defaults on the terms of the mortgage, so usually meaning they don't pay their taxes or insurance. Now, one difficult thing is heirs. So the only security on the reverse mortgage is the house. There's no personal requirement to pay it back. So if somebody passes away and they leave a surviving spouse who was their spouse at the time the mortgage was in taken out, they're a special type of heir and they get to hold on and not have the home foreclosed. But once the last borrower dies, their heirs, their adult children, whomever they left the property to, they either have to pay off the balance or to keep the loan. They have to pay off the balance or refinance it. Otherwise, they will lose the home to foreclosure. There's no option for them to take over the loan like there is for a regular loan, where you can just say, I'm the heir. I'd like to keep this loan and pay it. You can't do that with a reverse mortgage. Also, sometimes these heirs encounter title issues, and they have to go through probate or do something just so that they can sell the home if that's what they want to do. So what are some benefits and risks of reverse mortgages? So benefits, so you can receive payments monthly or as a lump sum or as a line of credit. So you actually can get money out of this, just like a regular home equity loan. And there's no restrictions on how to use the money. So you can pay cash, you can get cash, you can use it for home repairs, you can pay off debts. Sometimes people use it to pay off an existing mortgage if it was small and they need that money to do that. You can pay off tax liens. So different ways to use those funds. You can have emergency funds available. Again, you don't have to pay monthly. You can still live in the home, and but keep in mind it does work best if you don't intend to leave the property to your heirs, or you know that your heirs or estate can pay off the loan. Some risks. So the first one is you might just not qualify. Both spouses have to be over age 62. Property has to be in good condition. You have to have enough equity in the property. You cannot defer your taxes. So this is true with any mortgage. So stay tuned for other presentations about property taxes. But there, again, as I've said repeatedly, you have to pay the taxes. And you can still be foreclosed on for all the other types of reasons that you could lose a home. Plus, if you are out of the home for 12 months, you haven't maintained the home, haven't paid your taxes or HOA or insurance. Again, another risk, you can't leave to the heirs without paying off the loan. There's risk to surviving spouses if they weren't on the original mortgage. And the loan balance can even grow to exceed the value of the home. Reverse mortgage defaults and loss mitigation. So we talked about loss mitigation options for other loans like repayment plans and forbearances and modifications. The loss mitigation options for reverse mortgages are somewhat different. Now, we're specifically today talking about FHA-backed reversed mortgages, Federal Housing Administration. That is the vast majority of reverse mortgages. Those are highly regulated. Non-FHA or private label mortgages, there's very, very few, and they're going to have their own policies. So today we're talking about the standard one we see, which is the FHA mortgage. Um, So one confusing thing we see is when the property taxes or property insurance aren't paid, tax and the reverse mortgage servicer pays them for you, and now you pay the mortgage servicer back, and that's the case in other mortgages too. But it becomes confusing. I've had clients who thought they had to pay the taxing entity, and the tax office says we've been paid already, and it's actually owed to the mortgage company. Um, so in those cases, the servicer can review your income and see if you qualify for a specific type of repayment plan, and you can repay in up to 60 months. You get a little longer than you might otherwise. And repayment plans are generally offered only once, although HUD guidance is saying allow a second chance. And now you can do it if the arrears is up to $5,000. We're hoping maybe they'll go even more. But not everyone will qualify for a repayment plan. Um, there's guidance saying that they should just expect that you can do it if you say you can, but it can be tricky if they agree that you qualify for the plan. Then there can be something called informal delay. They just know that you owe some money and you work on repaying it, but they don't formalize the agreement as much. And then there's reinstatement. If you are able to pay all of the charges, you have the right to reinstate the loan, meaning even if they accelerated it, they set it for foreclosure. If you can pay what's arrears, you can get the loan reinstated. But keep in mind, attorney's fees and costs and so forth will be added to the loan balance. Then there's a special loss mitigation option just for reverse mortgages, something called an at-risk extension. And the youngest borrower has to be at least 80 years old. So if there's only one borrower and they're 80 years old, or there's spouses and they're both at least 80, then and they have to have some kind of critical medical issue or something that a foreclosure would make worse, and they can get a doctor's note to that effect. They have to take a chance at paying on a repayment plan, but if that doesn't work, they can just get a extension to pay without losing their home. So you usually have to recertify every year with a new doctor's note. New guidance says that you shouldn't have to, but they may still ask. So just so you're aware. And then this I'll go through a little quicker. There's a lot of text, but there are special non-borrowing spouse protections. Now, every spouse has to be on a reverse mortgage. They have to be a borrower. You can't take out a reverse mortgage by yourself if you're married. But in the past, that wasn't always the case. And so, like I talked about earlier, sometimes a surviving spouse is left and they weren't a borrower on the loan. There are now new regulations that allow them to just defer the due date of the loan, keep the loan in place for that surviving spouse. But they have to have been married to the borrower at the time the borrower took out the loan. They have to have a title interest. They have to live in the home as their home. And they do have to pay taxes, HOA, and insurance. And they can no longer take out any money. So if it was a line of credit or something, they can't take any money anymore. So again, the key date is August 4th in 2014. Prior to 2014, there were these types of loans that will have special non-borrowing spouse protections. Now, the issue we also encounter is heirs that were not spouses, adult children, people who inherited the home under a will. They don't have this extra right to basically defer the due date on the loan or to take over the loan. They have to either pay it off or let it be foreclosed. Um, so the mortgage servicer is supposed to try to find heirs, and they should be contacting the servicer. So if someone passes away, look for mortgage statements, contact the servicer, let them know. And the servicer is required to give them up to two 90 days periods of after death of the borrower. Um, so 6 months after the death of the borrower to do one of the following: to pay off the loan. So if the heirs want to keep the home, they have to refinance the loan or pay it off in some way. Sometimes it's difficult because there's title problems. The heirs aren't able to, they have that uh, tangled title we talked about earlier, and so they have to do uh, different things to consolidate title, but they have to find a way to get that in order so that another lender will lend to them to pay off the reverse mortgage and kind of convert it into a regular mortgage. Um, if they just don't want to deal with the foreclosure, but they don't want to keep the home, they can do something called a deed in lieu, meaning they just kind of sign over their rights. They also have the option to sell the property for at least 95% of the appraised value. So we talked about before how sometimes these loans can be even more than the value of the home by the time the person has passed and the loan is due. They still let you sell it for up to 95% of the appraised value. It may result in selling for less than is owed on the property. So the heir isn't necessarily getting any equity out of it, but maybe they want to sell it to a specific person or what have you. Um, you can ask for more than those 6 months to have more time to work this out, but they don't have to give you that extra time. They're usually more likely to do so if you can show that there's, a probate proceeding or that you have a actual contract to sell to sell the home. Um, some situations you might qualify for what's called cash for keys or probate costs to help the heirs move out or resolve the issue. So that you can ask about to see if you might if an heir might qualify. Um, so there's a nice consolidated flyer at HUD.gov that kind of lays out these options and gives you some more information. And then what if I don't qualify for loss mitigation? So whether you have a reverse mortgage, a forward mortgage, any kind of mortgage, what happens if whatever options there are, you just can't afford? So you might be able to refinance the mortgage through another loan with another mortgage company, or if it's a small forward mortgage and you're over 62, you might be able to get your own reverse mortgage. If you qualify, you might qualify for Chapter 13 bankruptcy to pay off what's due through the bankruptcy. Consult with a specialist and to see if you are able to afford the bankruptcy because there's actually a cost. You could try to sell the property on the open market rather than letting it just be foreclosed because people go to foreclosure sales to get deals on houses and to pay less than you might otherwise. So then you lose your equity. You are entitled to whatever excess is left if the property sells for more than is owed on the loan at a foreclosure sale, but usually there isn't any because they're selling only for what's owed. So try to sell the property on the market. So if you're able to realize any equity out of it, you at least get that money. With the mortgage servicer's permission, if you can't do that, sell it for the amount that's owed, you can do what's called a short sale or just give it back to them in a deed in lieu. Again, the servicer has to approve this. The benefits to you would be, avoiding the stress of foreclosure, and they may offer, cash for keys, some kind of limited money or relocation assistance to get you out of the home. There could be tax implications if they're forgiving a lot of the mortgage. So talk with a tax attorney or CPA or what have you if you're in that case. And again, if your home is foreclosed, because none of this works, they do have to actually evict you rather than you're not just out on the street the next day. HUD.gov is a place you can go to try and find a certified HUD housing counselor that can also provide you with guidance. So those were all different types of more traditional mortgages, mortgages that are regulated, have specific investors with specific rules. We wanted to add on one additional type of mortgage, which is called a contract for deed or executory contract. And that is generally done when you're buying from a private person. And it's kind of a little more of the Wild West in terms of what your rights are, but you do have rights. So executory contract basically just means a contract that's not complete from the beginning. So let's say you want to buy a car for cash and you sign a contract and you pay the cash and you say you're going to take it as is or whatever, and they sign something saying you bought it and you get title and you're done. That is not an executory contract because everything's done. But executory means you haven't finished the contract or it's going to be continued over time. In this case, part of the contract is that you don't get the loan, I'm sorry, you don't get title until the end of the contract. With a traditional mortgage or any of the ones we talked about, you get title with a lien and your continued obligation is to make payments, but you actually get a deed with lien, so it's clear to the world that you owe money, but it's still, you have title. With these kinds of contracts, and we often see them called contract for deed, land sale contracts, installment contracts. The seller doesn't give you title until the end. So it could be for 10 years or whatever, you don't get title until the end. Um, the, the seller just keeps the title, and unless you put the contract in the deed records, which we'll talk about, nobody in the world even knows that you have an ownership interest in this title. Um, to qualify as an executory contract, it has to be for at least 180 days. So if it's a very, very short contract, like we're going to give you money and you pay it off in 3 months, then that's a different body of law, but it has to be at least 180 days. And it's, again, commonly referred to as a contract for deed or a land sale contract or an installment contract. So who uses these types of contracts? So we often see them if a buyer has a lower credit score or a recent bankruptcy or can't get traditional financing, or maybe they're self-employed or what have you, and they have sporadic employment history. Maybe they have a high personal debt to income ratio. They've changed employment recently and it's taking a while to get back on their feet, or they can't afford a large down payment. They may require a down payment with the executory contract, but it might be smaller, or they don't want closing costs or what have you. The issue with these contracts is that they can potentially be predatory. There are, plenty of good lenders out there, but there are people who take advantage of it. And so Texas law has strict consumer protections for them. There was actually a Senate bill where it was stated that executive contracts are disfavored because they're potentially abusive. So the legislature recognized that. Texas Property Code Chapter 5, Subchapter D is where you find these rules. It applies to an executory contract or contract for deed for real property, meaning land, meaning house. It has to be used as your residence by the purchaser or purchaser family member. So it's not like if you're buying a second home. And again, it needs to be completed more than 180 days from execution. Includes residential lease agreements with purchase option, but some consumer protections don't apply. So one type of executory contract you might see is these rent to own. They're even yet their own special things. So we're today talking about the ones where you're actually buying the home outright, but you even have a few protections there. Now, it doesn't cover if your contract is with a government entity, if it's between family members. Keep that in mind. If the property is less than 1 acre, it's presumed to be residential. And once you meet all these criteria, there are actually laws and remedies and things available. So again, traditionally, the buyer under a contract for deed doesn't become the owner until all the payments are complete. But now there's options for the buyer to get a title interest in the contract, but you have to know you have that right. So these are risks. Another risk is that the buyer has limited control over the property. So if you're the contract for deed buyer, people don't necessarily know that you are that. And if you want to get your tax exemptions or whatever, there's additional steps you have to take. One thing that we'll be talking about is that the contract should be recorded in the property records, in the deed records, just like you put a regular deed, a general warranty deed or whatever, it has to be put in the property records. Now, the seller is supposed to do that, but if they don't, the buyer is allowed to put it in the deed records themselves. The issue we encounter is that to put a document in the deed records, it has to be notarized, and you have to have the original notarized copy, or it has to have come from a court. But in this case, it would have to be notarized. And a lot of contract for deeds, either they aren't notarized or the person can't find the original, so they don't record it. But there is a way around that where you can prepare an affidavit that is notarized saying you're attaching the deed, contract for deed, and it's the original copy. So just so you know, you have that option. Some other risks. Buyers can lose all the property and all the money they paid, the down payment, all of that, if they're not being on top of things. Under certain circumstances, the seller can just cancel the contract. The seller may try to just evict you, even if you have met certain criteria to where they're supposed to foreclose. Another thing we've encountered is the seller didn't have clear title. So as I've heard Nia often say, make sure you're going through a title company. The seller will claim to have clear title, but little do you know, they have a mortgage on the property, or they're an heir, but there are other heirs out there. And so they can't even give you clear title. That's a risk. And the seller can pretend to the world that they're the only one with the title interest and get new mortgages and liens, even though they're not supposed to. And again, they can attempt to evict you rather than foreclose. So some buyer protections. Again, as I stated earlier, you have the right to what's called convert the contract to recorded title by recording it in the deed records, and you have that absolute right now. The seller has no choice in the matter. The right to request a balance and a trustee. So you also have the right to know the amount owed. So sometimes we find that sellers aren't properly giving people accounting statements, and you have the entitlement to ask for that. You also have the right to ask for a trustee to be the one to sell the home if there's a foreclosure. So that's something to be in mind. You also have the right to deduct. So if the seller violates some Texas law and there's a amount owed, that a statutory damage, it says if the seller does this wrong thing, they owe $1,000. You can offset what you owe based on that. That would require litigation to do that, but it is good to know that you have that option. And you have the right to cancel. So you can cancel the contract for any reason within 14 days of the date of the contract by giving a specific notice. So the law sets out notice. So specifically, we've talked about how important it is to record the contract. So we're going to talk a little bit about that. Again, you can record it yourself. It must be the notarized original copy or attached to an affidavit. You can bring it to the clerk in person or mail it to them. Here's what needs to be on your affidavit if you have one of those contracts that's either not the original or not notarized. Your name, you may need to say that the affidavit is a true and correct copy that's attached. The attached is a true and correct copy of the original contract, and that you're recording it under Chapter 12 of the Property Code. You're going to refer to it as an executory contract for conveyance of real property under Chapter 5 of the Property Code. These are the governing laws. You'll put the property address, the legal description. So not only 123 Main Street, but lot 2, block 5, whatever that is, the name of the people who signed it, state that it wasn't recorded already and you want to record it now because you have that right under Chapter 5. And if the property is your homestead, you should state that on there as well. So what happens if the buyer, meaning yourself, ends up in a default situation, you've gotten behind? So first, the seller is required to use certain language and give you either 30 or 60 days to fix the problem, to make your payment. So if you've paid less than 40% of the contract or less than 48 payments, they have to give you 30 days to fix your problem. If the contract is not recorded, it's not in the deed records, then the seller can just cancel the contract and evict you. You evict, you pass over the whole foreclosure process, which takes longer. So it's in your best interest to have it recorded, so you can't just be evicted. If you have paid 40% or more, or the equivalent of 48 payments, or have recorded the contract, regardless of how much is paid, they have to give you 60 days to fix whatever problem. And then if you don't fix that problem in that 60 days, they can sell at a foreclosure sale and move to evict you. Okay, so it looks like we have reached the end of our presentation. And so I'll stop sharing my screen. And let's
Do
see.
you want to give your contact information also, Lauren?
Absolutely.
As you
And I could
gonna put that screen back up.
put that screen back up. Absolutely. Um, let's look for the share screen. Okay, so that is our Houston office, 713-652-0077, 713-652-0077. The toll-free number we gave earlier is also good. And then our website is lonestarlegal.org, LONESTARLEGAL.org.
Okay. I don't see any questions in the chat. However, I did have a couple of questions as we were going through. I jotted down a couple of things. Uh, and and throughout this Q&A process, again, if you guys have any questions, please feel free to unmute yourself or raise your hand or type it into the chat. I'm also monitoring the social media pages, so if there are any comments there, please feel free to include those and I'll read those aloud as well. So, but for right now, you said that you were talking about when you were talking about loss mitigation. In what instance would somebody not qualify for loss mitigation?
That's a good question. So let's say somebody owes a very large balance. Maybe their mortgage every month is pretty high and they weren't able to pay for a long time. They were qualified for forbearance for quite a long time. We've seen forbearances that are a year or more, and now suddenly they owe this huge amount. And the investor determines what is available to them to fix that amount. Maybe it says you can have reinstatement, you can pay it all at once, or you can have a repayment, but it's only a year, and they can't afford to make their regular mortgage payment plus an additional amount every month for a year. Maybe they go through modification, and that's like taking out a new loan essentially. They do an eligibility check, and maybe your income and expenses aren't there. There are the federally backed loans offer a lot of options, but like I mentioned, some loans are those private loans, and they may not be as generous with their options. So many times people qualify, but there are times when they might not.
Hmm.
Does that
Okay.
answer a question?
Yes. And then the same thing with a short sale. When wouldn't somebody qualify for a short sale?
That's a really good
Or
good question. That's my understanding, and I want to add that caveat, is that's a investor's business decision if they're going to allow someone to sell for less than is owed. For example, if somebody has federal backing, like a reverse mortgage, HUD, FHA insures it. They have FHA insurance, and they can make a claim on that insurance if the mortgage sells, if the property sells for less than it's owed. But if they don't have that, they may say, well, we think we can get more at a foreclosure sale. So this is, but I want to clarify that that's my thought or my understanding, but it would really be a business decision to get more clarity on why.
Is your question, can you change? I don't know what this request is for meeting questions. Let me see. I'm gonna say not now for, I'm not sure what that request was. I'm not that familiar with Zoom for the participant that just asked that question to know what that actually meant, that little thing that just popped up on the screen. So
Okay.
if you could message me or tell me what exactly it was that you were looking for there, that would be very helpful. Um,
Yeah, I didn't see a message and I don't see one in the chat. So,
no, there was a message that popped up that someone was requesting a question something. I didn't see it.
okay.
Um, what is the total timeline for foreclosure? So if somebody goes through the process, financial hardship they're experiencing, once, assuming that they are in contact with the mortgage company and, so on and so forth, what's the
Mhm.
timeline from beginning to end?
Excellent question. So, first of all, I want to emphasize what you said was that they're in contact. So, and I was going to mention this. Don't put your head under the sand. Don't say, I can't afford it, so I'm not going to talk to my mortgage company. As soon as you're behind, start calling them to find out if you qualify for these loss mitigation options. And that said, so that depends. But I mean, the shortest timeline, as we mentioned, they have to have be at least 120 days in arrears before the first um, official recorded document or legal filing in a court is allowed to be done. So somebody would have had to be 4 months behind and not qualified for anything before somebody could have recorded that 21 day foreclosure sale notice. So, then you're looking at a bare minimum math wise ish, the 5 months. But we don't know, maybe it could be longer. Maybe they gave them a forbearance, or maybe they're doing judicial foreclosure and now they have a lawsuit and it takes that time. So, um, I guess the takeaway is it's not as imminent or as quick as an eviction, for example, but it can happen in less than a year in Texas. There are some states where it takes longer, but half a year and it could happen. So definitely be on top of your servicer to make sure they know that you're trying to get back in good standing.
So you have potential options. So it's not like after the first
Yes,
month, now you're going to be displaced because it's a month behind now. So
absolutely.
there is some time there
Yes.
to get
And
it
and
done.
again, that's with all the traditional mortgages, and that's why we mentioned the contracts for deed, because depending on things and if it's not recorded, you can get something that quick. You can get in trouble that quick. But yes, if you're only a month behind, I'd say only, every bit behind isn't good, but absolutely start finding out if you have options.
And why do they require you to be 4 months behind before they offer you some kind of reprieve or some kind of assistance or anything like that? I've heard that or have seen that often, that maybe somebody's only a month behind and they need some, or 2 months behind and they need some extra time or to put a payment on the back end or whatever it is. But most mortgage companies won't talk to you until you are indeed 3, 4, 5 months behind before they'll even assist you. Why is that?
So that's a very good question. I have and thank you so I can clarify and add some additional context. So that 4 month that arrears requirement is under the Real Estate Settlement Procedures Act. It's a federal law that governs how far back someone has to be because before they can actually proceed with foreclosing. In terms of doing loss mitigation, and you may have had different experiences than me, but many mortgage servicers will talk to you from my experience, and maybe you're not asking the question in the way they want to hear it, or they're what have you. But they will offer, they'll say, you're 2 months behind. Can you do a repayment plan and so forth? So they you're absolutely right. Sometimes you have to call them and ask 3 or 4 different ways, but many servicers should begin the process of working with you as soon as you tell them that you are ready to do so.
Okay.
And if not, you can send them to us and we could see if we
And
can
that
help you.
was one of my next questions. At what point does someone reach out to a legal service organization like Lone Star Legal Aid when they're facing foreclosure or potentially could be facing foreclosure?
Good question. First of all, any time, and the sooner the better. So if as soon as you know you're in arrears and you want to figure out what your options are and you're having trouble, give us a call because maybe you qualify for a forbearance or something, even if you don't have the money to pay. If your mortgage servicer is giving you problems, like saying you don't qualify for anything, or they're saying they're mailing you something and they haven't mailed it. We see that. Um, you can contact us. If you're set for foreclosure and the closer you get to it, you know, time-wise, the fewer options you may have, but certainly contact us to see if there's anything that can be done.
Other than the first Tuesday before the auction, is it ever a time when it's too or across a certain time period when it's too late to contact you guys to save a property from foreclosure?
And I'd say you can always contact us. It's just I'd argue your options get reduced over time. If it's the day before foreclosure sale, the mortgage servicer may decide that it's too late to offer you loss mitigation, and the investor may support that decision. So just contact us. You might qualify for bankruptcy. Bankruptcy provides what's called an automatic stay, which is where all collection activities have to halt while you are figuring out what's going on, and foreclosure is a type of collection activity. Again, you have to be able to pay off the arrears on the mortgage and the regular mortgage as part of that. So if it's, talk with a bankruptcy attorney to see if that's something that's good for you, but that's one way to kind of swoop in. Um, but otherwise, certainly call us and we'll see. We've had some where they're set and we were able to stop. It's just usually you need a little lead time.
And I know this is a double negative, but don't not say anything. You have to
Absolutely.
you have to communicate with somebody and ask them questions and figure out, you know, even if the person can't help or whatever, at least where do I go to? What do I do? Who do I talk to? You got to say something. You can't wait till they come and post a sign on the lawn or, I know a lot of people get real prideful about asking questions or reaching out for assistance, but as much as you may not want anybody in your business, when that foreclosure sign goes on the lawn, somebody's gonna know. You know what I mean?
Yeah,
So don't wait until it gets to that point where you're reaching out to somebody. So if you know, reach out, get some help.
absolutely.
Um, I wanted to ask also about excess proceeds. You said generally there isn't a much of excess proceeds because they sell it for what is actually owed. But what if it is sold in
Ex
excess?
Excellent
What's
question.
that
So,
process like?
sure. So if generally speaking, just as a trend, so the mortgage company can't take any more than is owed. They're just not allowed. And so they will start the bidding at how much is owed to them. And as a general trend, people don't pay more than that. However, there could be, a bidding war. It could be a really, valuable property or whatever. And then there is extra money once all the dust settles. And it'll go one of two places. If it was a non-judicial, non-judge, non-lawsuit um, excess proceed, it will go to the trustee who did the foreclosure sale. And so you'll have to contact that office. When you got your notice of foreclosure in the mail, it will say, this is the attorney firm who's sending you the letter, contact them. If it was a judicial judge court ordered foreclosure, then the money will go to the court registry. The court kind of has a little bank, and it'll go to the court that was over the lawsuit. So if it's uh, a title clearing suit and they brought or expedited foreclosure suit and it went to a district court, 1, 2, 3, then that court's registry will have the money and you'll have to file an application to get that money out to prove you're the one entitled to it. Texas Law Help has a a template for that, texaslawhelp.org. Some judges have a template for that. Um, if you're trying to get the money just for yourself, then you would be able to represent yourself. If there's numerous heirs involved, then they're all entitled to a part. That is something we also help people with when they qualify.
Okay. A question here. How far in arrears can you go before foreclosure on property tax?
Okay, that is a very good question, and it's generally further in arrears than mortgages, but because it's judicial, but it can still happen quickly. So once you haven't paid your taxes, the taxing entities decide when they're going to file suit. And I'll be honest, I'm not sure. They're allowed to start collections as soon as, July 1 after the taxes were due. If you only owe a teeny little bit, they may say it's not, in their interest to pay all the court costs and stuff to bring a suit, and they may let it roll over for another year or what have you. If you owe quite a large amount, they may choose to sue you. And don't forget, some people have multiple taxing jurisdictions. So you may have a school district that does its own taxing and a MUD district that does its taxing and the county that does its taxing. And they may have different thresholds at which they bring a suit. Then once the suit is brought, then you have to get service on everyone and get a trial date and so forth. So that could be several more months. I don't know if that answers the question because it's not like a precise amount. You're 5,000 behind and they file suit. It's more like whenever they choose to, but they're not allowed to file before July 1, the year that you're behind.
But technically you're in default or in arrear after, what was it, February 1st? Because they're
Yes,
due January
they're due
1st.
January 31st. So February
So
1st, you're when you're getting your interest and all that.
so all the interest and penalties start accruing February 1st.
Hmm.
And then they apply the attorney's fees come July.
They can come July, yes.
Okay. All right. I hope that answers your question. Um, those are all the questions that I actually had. I don't know if there's anything else. I am looking through all of our social media just to make sure. What's the biggest misconception do you think that people have when it comes to when you were talking about the executory contract or the for sale by owner type things that they don't know about, other than the recording their ownership interest?
Oh, that's a good question, and I would only have like my own personal anecdotal evidence. They don't
Uh-oh,
know
did
they
I
can
lose?
record it. And let's see, it says my internet connection is unstable. I don't know if you're able to hear me.
I
Okay.
can.
Okay, now you can. And then the other thing is they may assume that they don't have many rights. They know they don't have a traditional mortgage, and the seller says, "Look, if you don't pay me by X date, I'm going to evict you." And sometimes they are successful with that because the contract might look a lot like a traditional lease. So there may be more or fewer protections. You got to read the contract in detail, but people think that, okay, this person can just make me leave, and they don't know that maybe they have rights.
Do you find that a lot of people sometimes just choose to walk away from properties because they don't know what their rights are, or they just choose not to deal with it and be bothered with it, that they just, just say, forget it, let me just go find another place and, because they just think there's no way for me to get out of this. So
That's a
I
good
just went away.
question. I would say because the people who are coming to us are trying not to walk away, I don't see many people that are doing that. But out in the world, I don't know how many people have said, I must have no options, I'm going to leave. But I bet you there's quite a lot of them.
Okay.
That's,
So
yes.
So if there's anybody watching, or if you guys know of anybody that may be facing foreclosure, if you could just let them know that there are some options, that there's an opportunity to potentially save their property as opposed to just kind of walking away from it. Because you never know who's actually going through that kind of financial hardship and just may be too prideful to ask for, some help, but just, be surprised just kind of mentioning it in passing. Hey, I was on this webinar, the other day, and they were talking about blah 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 blah. Oh, I didn't know, somebody else that may need this information that don't know. You know what I mean?
Mhm.
Um,
Absolutely.
let's see what else is there. I believe that's all we have. Um, Ms. Richards, I hope that answered your question. Mr. Harris, if there was anything else that you needed or something else that I didn't do when you were asking the question and that kind of popped up there, please let us. I see. Okay, you unmuted yourself, Miss
Yes,
Richards.
ma'am. Yes,
Okay.
ma'am. I didn't get the the timeline. It kind of broke up on me when the presenter was talking, but I didn't
Oh,
get the timeline on when it actually is a problem
for the
with the
property tax
property
or for
taxes. Yes,
for the
ma'am.
prop?
With the
Okay.
property taxes.
Okay.
Yes, ma'am.
Okay, thank you, Ms. Richards. So effective February 1 is when taxes are in arrears and interest starts to accrue and penalties. And then July 1, they can decide if they want to send the arrears to collections, get an attorney involved, send you letters, and then thereafter file suit. Um, Again, if I don't know each individual taxing entity and how much in arrears they decide to sue. So I've seen people where they've gone many years without getting sued. I've seen people where they've sued right away. So that I'm not sure. And then once you have the lawsuit, that could take, several months. It depends if there's a lot of errors, if they're having to appoint an ad litem to find people, or if it's very straightforward, how long that might take. Um, and there are other AMOS presentations on property taxes, and we have a presentation. The tax office has a presentation that includes information about payment plans. So if it's at all possible, before, thinking that far in the future of foreclosure, see if you qualify for a payment plan. And that will stop the collections process and lower the interest. Also, if you're age 65 or older or disabled, you can qualify for a tax deferral. So, and it has to be your homestead. That's same with exemptions and so forth. But for your homestead, if you qualify for a tax deferral, the due date is delayed indefinitely, meaning they can't foreclose or sue you. There will still be interest, but it'll be less than it would normally. So, and those things will stop a foreclosure sale, they'll stop a tax lawsuit. So just like with mortgages, if you're behind, don't assume there's nothing you can do. Talk to your taxing entities and see what options you have.
And Ms. Richards, if you're interested in viewing those previous presentations, where Lone Star did a presentation about property tax foreclosure. In addition to that, we have the tax office that does their presentation that she mentioned about the different payment options and things like that. Just shoot me a note after I send out the link of this recording, and I'll be happy to send you over the recorded presentation of those particular topics where they kind of dive deep into property taxes and payment options and what that foreclosure process is like. I could send you that. So just let me know.
That would be great. Thank you.
Okay. All right. Um, like I said, I believe that is just about it. I don't see anything else on the social media pages. So I believe we are going to give you all your time back for the remainder of the afternoon. So thank you very much, Ms. Lauren. You did a great
Thank
job
you.
flying solo today.
Thank you. Yeah.
Again,
Um,
we know that there's a lot of information that was presented here today. I will be sending out a link of the recording of this presentation so that you all may go back and view it and again, potentially share with other people that may find the information to be beneficial as well. If you do have any other questions that come up, the contact information and the website for Lone Star Legal Aid, if you're interested in applying for their service, will be included in the link that I sent out to all of you. For those folks that are joining us on social media, please feel free to reach out to me at our office. My email address is n as in Nia Murray, Murry, at nrcdc.org. If you have any questions or need the links or the resources that are going to be provided to all of the registered participants, and just let us know. And again, if there are other presentations that we don't currently offer that you all may be interested in, please feel free to reach out and let us know that as well, as we're planning for our fall scheduled workshops. So with that being said, thank you all very much
Thank
for joining us.
you.
Oh, oh, were you waving? You said, was there
Oh, I
something
just
else,
said
Lauren?
thank you.
Oh, so with that being said, you all have a wonderful remainder of your afternoon. It looks like it's getting a little cloudy out there. I hear some rumbles. So stay safe as you're driving. Stay dry. Take care of yourselves, and we will see you all next time.
Bye. Thank you.
Thank you, Lauren.
Thank you. Bye.